In this video, I'll provide a review of Disney and what I personally look for when evaluating potential stock purchases. In the first section of the video, I'll run through what the company does and how they make money. Then I'll look at some of the numbers and metrics that I find useful in evaluating companies, as well as looking at the dividend history and also the company's revenue, net income and cash flow. And finally, I'll offer my own personal thoughts and opinions on the stock. So, who are Disney and how does their business operate? I'd be very surprised if anyone has never heard of the Walt Disney Company before. It's a colossal, diversified, international family entertainment and media enterprise, and was founded in 1923. A driving force in the entertainment industry, the Walt Disney Company is best known for bringing decades of fantasy and fun to families, through its amusement parks, television series, and many classic live-action and animated motion pictures. Characters such as Mickey Mouse, Snow White, and Cinderella have been immortalized in cartoon history, and films such as The Lion King, Pinocchio, Bambi, Sleeping Beauty, Toy Story, and Frozen have stood the tests of time and remain children's classics throughout all generations. Starting in Q1 2021, Disney reorganized its company structure and now operates through two main business segments: Disney Media and Entertainment Distribution, and Disney Parks, Experiences and Products. Disney's media and entertainment businesses is further separated into three components: linear networks, direct-to-consumer, and content sales, licensing and other. Disney's linear network segment operates a long list of television channels, including domestic and international cable networks such as Disney, ESPN, National Geographic, ABC Television Network, and 8 domestic television stations. Disney are therefore able to sell advertising space on these platforms. Disney's direct-to-consumer segment is comprised of its own various streaming services, including Disney Plus, Disney Plus Hotstar, ESPN Plus, Hulu, and Star Plus. Disney's content sales, licensing and other segment sells film and television content to third-party TV and subscription video on-demand services. So, for example, this would be where they might sell affiliate fees for a Disney film to another television company. The segment also includes the following operations: theatrical distribution, i.e. the marketing and supply of films to the general public; home entertainment distribution, such as DVD and Blu-ray; music distribution; staging and licensing of live entertainment events on Broadway and around the world; and post-production services through Industrial Light and Magic and Skywalker Sound. Disney's Parks, Experiences and Products segment is comprised of theme parks and resorts in Florida, California, Hawaii, Paris, Hong Kong and Shanghai. It also includes a cruise line and holiday club. Revenue comes mainly from selling theme park admissions, food, beverages, various merchandise, resort and vacation stays, and royalties from licensing intellectual properties. While Disney produces high-quality video content under its own name, it has used acquisitions to become the owner of intellectual property rights to a number of blockbuster film and TV franchises. Here are some of the assets held under the Disney umbrella: 20th Century Studios, previously 20th Century Fox; Marvel Entertainment; Lucasfilm Limited; Pixar; Searchlight Pictures, previously Fox Searchlight Pictures; and Blue Sky Studios. And here is a very short list of some of the blockbuster names that Disney actually own: Star Wars, The Muppets, the Marvel Cinematic Universe, Disney Princesses and Princes, the Chronicles of Narnia franchise, the Pirates of the Caribbean franchise, Pixar films such as Toy Story, The Incredibles and Cars, the Indiana Jones franchise, the Alien Predator franchise, the Planet of the Apes franchise, Die Hard, Home Alone, The Simpsons, and Family Guy. I could probably create a very long video listing everything, but I hope you get the picture. So what does the revenue split look like for these segments? I've taken the figures from Q4 2021 just to give a flavour of the revenue split per segment. So we can see that the linear networks brings in the most revenue, followed by direct-to-consumer and the parks, experiences and products, and then lastly the content, sales, licensing and other. So now looking at both business segments over the last few years, we can see that Disney Media and Entertainment Distribution is responsible for the majority of the revenue. Understandably, since the parks closed in 2020, we have seen an expected drop in the revenue that this segment brings in. Let's now take a look through the numbers that I find useful in evaluating stocks. If you've seen my other stock review videos, you'll know that I stay consistent with the metrics that I look into. However, due to Disney not paying a dividend, there are a few not applicables this time. As Disney isn't currently paying a dividend, it has a 0% yield. In recent history, Disney's dividend yield has always been in the 1% to 2% range. This might be considered low to some investors, but it's the yield on cost that I'd be interested in during the long term. I did a video recently where I looked into yield on cost if you're interested. We don't have any consecutive years of dividend growth, and the payout ratio is currently 0%. The market cap of Disney is $284.03 billion, which makes it the 19th largest company in America by market cap. Personally, I hold a lot of these large blue chip companies in my dividend portfolio, as they tend to be established, secure businesses, and I feel that they're a lot less risky than smaller cap companies and new startups. Disney has a current share price of $154.90, and this puts it towards the lower end of the 52-week price range. The current price does seem to be at a bit of a discount when you compare it to the 50-day average of $158.92 and the 200-day average of $174.38. So now let's look at the yearly dividend history of the company based on payment dates. I like to chart dividend graphs using payment dates, but for some reason Disney don't tend to pay their dividends on fixed dates, which does make the history look somewhat erratic. For example, looking at 2002, it looks like they didn't pay a dividend in that year, which is technically true. However, they just changed the time between the declaration date and the payment date. Prior to 2002, Disney declared a dividend in November and then paid in December. Then in 2002, they changed this and declared the dividend in December and paid in January. We can see that we are looking to be trending upwards, even with the inconsistent nature of the payment dates. But then in 2020, when the pandemic struck, Disney had to close its doors on several businesses that contribute significantly to its bottom line. Disney's management quickly understood that closing theme parks, hotels, cruise lines and retail shops would likely damage their cash flows quite severely. Consequently, they sensibly suspended the dividend to conserve their cash and ensure they were better equipped to survive the pandemic. Disney haven't restarted their dividend just yet, and this is something that I'll discuss later on in the video, when I give my thoughts and opinions on the future of Disney. Now let's have a look at the chart showing Disney's revenue, cash flow and net income. While I always like to look at the dividend history of a company, I think it's also important to look at the company's ability to generate income, as the earnings and cash flow of the company are key to future dividend payments. The amounts in this graph are phenomenal. The numbers here are in the billions. We saw quite a steady upward trend in revenue. Then in early 2019, we see a real steep upside towards the $80 billion mark. After looking through the company's annual reports, I see that there's a note to the accounts relating to an acquisition of TFCF. Upon further investigation, this is where Disney completed the purchase of entertainment giant 21st Century Fox. So this explains the boost in revenue. As Disney bought 21st Century Fox, their accounts will have been consolidated with Disney's remaining operations. So basically, the revenue from the 21st Century Fox business will be added to Disney's existing amounts. Then, as expected, we see an equally sharp decline caused by the pandemic. It's pleasing now for me to see that there is a recovery of sorts over 2021. Then, looking at the yellow net income line, this follows the revenue line quite nicely until early 2019. Then, interestingly, as the revenue increases, the net income starts to decline. As the formula for net income is revenue minus expenses, there must have been some significant expenditure during this period, and there was, due to the cash purchase of 21st Century Fox. Unfortunately, again due to the pandemic, this downtrend of net income continued into 2020, but we can again see signs of recovery over 2021. If we also look at the profit margin of Disney, we can see some consistency before 2019. From the end of 2015 to the end of 2018, it seemed as though the management had really got their costs under control, and we saw a slight upward trend in the margin. Profit margins can vary from industry to industry and size of business, but for context, a 20% margin is generally considered good, 10% average, and 5% low. It will be interesting now to see how the management try and recover their margin to pre-pandemic levels over the coming years. Looking at the orange cash flow line, we see a similar theme, with a slight upward trend until the end of 2018, a downward trend caused by the cash purchase of 21st Century Fox, and then a small recovery post-pandemic. It's important to note that this cash flow line hasn't dipped into the negatives, so we are still seeing cash flowing into the business. What I also like to look at is a company's cash position at the end of each financial year, just to see what the company has in reserve, should they ever need to draw upon it. Looking at this graph, we can see Disney's cash balance is healthy, with the last report in September showing a $15 billion cash reserve. It seems that by suspending the dividend in 2020, Disney has kept a large buffer of cash available to ensure that the business can still operate effectively. So what is my opinion on Disney? In my portfolio, I own a few long-term dividend stocks that are my forever holds. These are stocks that I never intend on selling, and I would put Disney in this category. I just find it extremely difficult to bet against Disney. They've been around for nearly a century now, entertaining families from around the world in multiple platform and mediums, from blockbuster films at the cinema, to DVDs and home streaming, to amusement parks and merchandise. They really do have a massive presence worldwide. At the core of the company is its unique ability to tell stories that resonate. Disney can make a movie that becomes a hit at the cinema. Then that same film can attract subscribers to its streaming services, and eventually it could become an attraction at one of its theme parks, and even made into merchandise that can be sold in stores. The order of that process can be mixed and matched, but generally touches multiple revenue-generating points no matter how it begins. When you look at stories like Cinderella and The Lion King, you see parents that grew up loving these stories, now introducing them to their own children. And then those children grow up and introduce it to their children. Disney's products really are uniquely multi-generational, and absolutely stand the tests of time. And on top of their established Disney library, they now own a monumental collection of well-known film titles and franchises, through clever acquisitions, as I discussed earlier. The company seems to really adapt well to fit in with changing consumer tastes. Most recently, this has meant putting an emphasis on expanding its streaming services. Overall, Disney+, Hulu, and ESPN Plus have amassed 174 million paying subscribers. By 2024, the management expects Disney will have over 300 million. With Disney Plus still to launch in many regions around the world, including Eastern Europe, the Middle East, Africa, Russia, and China, there are still lots of areas for Disney Plus to expand its reach. Just looking at Disney Plus alone, which was launched in November 2019, we can see some really exciting growth numbers on this chart. Going from 26.5 million subscribers in Q1 2020 to 118.1 million in Q4 of 2021. It's been a meteoric rise. Disney Plus took about 19 months to hit the 100 million subscriber mark, which it managed in March 2021. Netflix, by contrast, took a decade to reach that milestone. To put those numbers into context, let's see how that compares to other popular streaming services. In November 2021, Netflix were way out in front with 214 million subscribers. Amazon Video had 175 million, and Disney had 118.1 million. So they're not doing too badly, and will no doubt have ambitions to disrupt the top two. It's also worth remembering that alongside Disney Plus, Disney also owns Hulu and ESPN+. Admittedly, the short term could be a bit challenging for Disney as it continues to navigate in an environment impeded by the pandemic. But over time, I'd expect them to gradually welcome people back in person to theme parks, movie theatres, hotels and cruise ships. That's another reason why I always stress the importance of having a long-term time horizon, and not just look at what's going on in the short term. I think there is one main question to ask as a dividend investor, and that would be, when will the dividend return? And to answer that, I'm going to play a clip by Bob Chapek, the CEO of Disney, who answers this in the Q4 2021 earnings report. When asked about reinstating the dividend, Bob said,
"Well, once we get back to a more normalized operating environment where we're back to single A and, our cash flow is such that we're not, we don't have the concerns that we've had over the last couple of years, I think what we're going to do is, number one, our clear priority, and the board agrees with management that the clear priority is funding our new growth businesses that we've got. But once we get to a point where, again, our cash flow is funding that, handling some of the debt that we've got, then everyone agrees that it would be a great thing to reinstate that dividend and do share buybacks. But that's sort of in the distant future, and we're not going to entertain doing that until we can reach that single A level. We have clear sailing from here, and this pandemic's in the rearview mirror.
This is really pleasing to hear. As you mentioned, Disney's management are committed to funding their new growth businesses first of all. This is exciting as it means that they should become a stronger company afterwards, which will mean a healthier and more sustainable dividend in the future. And from the 2021 Q3 report, Disney CFO Christine McCarthy also recently reiterated the company's long-term commitment to paying a dividend, saying,
"And finally, in light of the ongoing recovery from the COVID-19 pandemic, as well as our continued prioritization of investments that support our growth initiatives, the board decided not to declare or pay a dividend for the first half of fiscal 2021. Longer term, we do anticipate that both dividends and share repurchases will remain a part of our capital allocation strategy."
In its 2019 fiscal year, the last before the pandemic disrupted its business, Disney paid cash dividends of $2.9 billion. When Disney decides to pay a dividend again, they're not under any obligation to pay that same figure. Disney could choose to pay a lower amount, or a higher one to make up for the lost time. Still, what amount the dividend restarts at, and when it restarts, will ultimately depend on the company's results and balance sheet. I don't believe that the management will pay a dividend if it's not in the best interests of the company. It's for all these reasons that I see this company as a long-term hold. I currently own 9 shares of Disney, and I want to build up a large position in advance of the dividend restarting. At the current price, this is below my original cost basis, so I will be looking to average down should the price remain in this range. This isn't investment advice, and you should always do your own research and due diligence before making any stock purchases. I hope that you've enjoyed this stock review and taken some value from it. If you have, then please like the video and subscribe to the channel to make sure that you don't miss any future videos. Also, please let me know what stocks you'd like me to review in the comments section below. Thanks again for watching, and I'll see you in the next video.